Money Mindset.
I think that sounds alright.
Hello everyone and welcome back to episode 3 of Millennial Money Mindset, where we give you some guidance on how best to invest your money or just to start investing and thinking about your future. We've already touched on how it can impact your mental health. Many of us worry about money, but we spoke previously about the 5 best tips for would-be investors, and now we're going to talk about the 5 mistakes would-be investors make. So Neil, in terms of those 5 mistakes, what is number 1?
So number 1 is investing in the latest fad. So we talked a lot about investing versus speculation. So there's always a new thing out, new technology, and technology like Bitcoin is always a topic that my clients talk about, and how the blockchain technology is going to be in the future. The technology itself, it's amazing. It's going to change the future, similar to what the internet has done in the past, in the 90s, etc. But we need to know, essentially, are you speculating or are you investing? With Bitcoin, for instance, are you jumping on the quicker things go up, tends to quicker just to come down as well. So like Bitcoin, it rose really quickly, but then again it can come down quite quickly as well.
What would you say the reason for that rise and that fall was?
So it's just the energy behind it. I mean, I think people can see the future of how blockchain, the technology, it's going to make things easier, and using how that technology will actually go on and improve people's lives. It's very similar to, I remember the first stock I bought was lastminute.com. In the internet age, I bought one stock, and looking back now, that's one of the riskiest things you can do, just buy one company in a stock, especially in kind of an unknown market like the internet. I mean, people didn't know. If you ask people on the streets in the 90s what Amazon was, what Netflix was, what a Google was, like people didn't know these because these companies hadn't been established. The companies that are going to change the world in the next 20 years are not even envisaged today. So, but from an investment point of view, for building long-term wealth, kind of putting all your money into one fad, it's not a good way. Essentially, putting all your money, all your eggs in one basket, so to speak. But yeah. Kind of,
also, it comes around to the points we made in episode 2 where we talked about research. Yeah. If your research is literally because there's hype, that's not research, is it? That's a fad, and you're just being drawn along with the hype.
Yeah, and it's human emotion as well. It's quite, it's easy to get kind of caught up. Humans are emotional creatures, and it's different parts of the brain that light up when there's everyone kind of wants to be on the bandwagon, and it comes back to investing is simple, but it's not easy. Like sometimes it's quite difficult to not put all your money into Bitcoin and kind of lose it all. I mean, I'm not against, I would say 4% of your portfolio should be, or could be, for what I call gift or gamble. So either you can use, it's essentially managing your portfolio sensibly, and the technology today is you can do that with your portfolio compared to what you could have done 10, 20 years ago. There's no way you could kind of, the ease of buying and selling shares today, it's amazing what you can do. The hardest thing is managing yourself. That's essentially what I'm trying to teach people.
So one of the, I think, emotions that should fight against, from what you're alluding to, is probably FOMO, a fear of missing out.
Yeah, exactly.
So you see a lot of people buying it, you don't want to be the person who doesn't make millions.
Yeah.
As we've seen with Bitcoin, a lot of people have lost a lot of money rather than become super rich.
Yeah.
So what would your tip number 2 be?
So spending more than you can earn. So not having, or spending more than you actually make. So wealth is not the same as income. So you can make a lot of money, you can have a big income, but then you can spend it all. So really, it's building long-term wealth. There's a great book about this postman who basically built up a massive portfolio just on a real small income, just by doing real sensible things like investing every month. Like, you don't necessarily need to have a massive income to build long-term wealth. You can do simple things that can pay off in the long term.
Like we talked about compound interest, just having 10% of your salary, or at least 10% of your salary going through. There's like an MIT lecturer called Scott Galloway, and he talked about how, like you said, there's a difference between wealth and income. He said you could be a millionaire, but if you've got 999,000 expenses, then you're not really a millionaire.
Exactly.
So it's about managing what you have. So in terms of tip 3, what would it be?
So try not to time the market. So this is, I used to trade gas. So basically my job used to be to look at graphs and trying to time the market. So it's kind of ironic that I'm saying don't do this, but
so then elaborate what time the market means to us lay people.
So it's like trying to look at a graph and seeing when's a good time to buy and when a good time to sell is. This is going down the trading route. So you're actually buying and selling, kind of trading and not investing. So if you're looking to build long-term wealth, to try and time the market you're going to get caught out eventually. And also not just because you might buy at the wrong time, but also broker fees. So every time you buy and sell a stock or an asset, you're paying you're paying a broker fee to actually transact this, and you're paying tax as well. So it's a bit like if you're buying a house and you buy a house 2 or 3 times a year, you're paying stamp duty, you're paying estate agent fees, you're paying. So it's getting in and out of the market, trying to time the market. It's not necessarily I'm just trying to make things as easy as possible, and to try and time the market. These things like essentially erode what you're doing long term. It's better to do all the good stuff we're talking about, like invest for the long term and have a diverse portfolio.
So we're kind of trying to say that just because you've maybe read one book or done a little bit of research, you're not a trader. Just take your time.
And also it's knowing what your aims and objectives are. We talked about having a long-term plan. By having that long-term plan, it reduces the need to think you're buying and selling all the time. And the media are terrible at this, because the front page says this stock is going up, or because I saw in a newspaper today Honda losing lots of jobs, and it's coming back to that mindset as well. That emotional part of your brain kind of lights up, and it gives that fight or flight thing where you're like, I've got to get out of the market because it's really that we're emotional creatures, and that kind of the hormones that are released when we see that kind of fight or flight reaction. It's not a good way to build long-term wealth. So I'd say that's one of the mistakes, to try and time the market rather than time in the market, where you're essentially paying yourself first in every month, and it kind of drip feed that into the market long term.
So then our next mistake for people to avoid would be?
Well, it's more knowing how much is enough. So knowing coming back to knowing your plan, knowing how much you want to live on for the rest of your life. So it's having the difference between, do you want a big lifestyle where you need much more assets or much more income, or having a small lifestyle where you're because you might not have those elaborate lifestyles that you don't necessarily need to live on. You don't need that kind of huge lifestyle, you need that assets. So it's coming down to different personalities as well. If you want the big cars and the kind of the big TV, that's fine. It don't mean that problem. You're just going to have to build more lifestyles to support. You're going to have to have more assets to support you in that. To pay that income in your retirement when you stop working.
So the way that when Neil explains this to me, the way that I understood it was kind of like, if we go back to the seed analogy, if you're planting that seed and your tree is yielding lots of fruit, just how much fruit are you expecting to eat when you get to a certain age? You just don't want to be wasting fruit. You want to be also living in the present and enjoying life. So don't invest too much.
Exactly. Or then alternatively, you can say, actually, right, 2-3 years, I'm going to work really, really hard. So 2-3 years, because you know you're young, and you can, you're like, right, I'm going to dedicate 2-3, and then you're actually going to build loads of assets, and you're like, right, I've built enough pot, and now I can essentially take it easy because you've built all those assets. And there's a big movement called FIRE, so and it's an acronym for financial independence, retire early. So if you have those assets, you can essentially say, right, I've got enough to live on for the rest of my life. You don't have to go and work for that boss that you don't necessarily like. You don't have to sit next to that person because you need that income. If you've built up enough assets over your lifetime, you can have another, or even you can work a side job and create a business in your side as a side project, and that could be kind of fueling, or that can essentially be giving you more of an income to live on for the rest of your life.
So you can have that secondary income that everyone always talks about.
Yeah.
So you're not reliant on that one income stream.
Yeah.
So in terms of our fifth tip, am I correct?
So I made a mistake when I first started investing, is not to put it into a tax efficient vehicle. So there, in the UK, you've got an ISA where you can put £20,000 into an ISA, which is essentially like a car. Think of it like a car where you put petrol in. Well, a tax efficient vehicle is like a hybrid car where that petrol, or because it's a hybrid, it will get you further than if you just put, if you just invest outside of that tax kind of asset, that kind of tax wrapper, so to speak.
And this is also where the government are basically wanting you to invest to secure your future by hopefully putting some money aside.
Exactly. So tax is a good thing. So it pays for schools, it pays for hospitals, it pays for our roads. So I'm not saying we're not trying to get away from paying tax. Everyone, to live in a good society, we all pay tax.
Yeah.
But there are good things that government can do to encourage people to invest for the future, because there is a retirement cliff edge coming up where people aren't putting enough money, especially millennials. We're not putting enough away for our retirement. So the government have kind of give these tax efficient schemes to help you get to where you want to get to quicker. So it's a bit like, I think of it like smoking. Like smoking is obviously terribly bad for our health, and we all know that. And the government put a tax on smoking, so it discourages us from smoking because it causes cancers, all that bad stuff. But on the flip side, like the government puts tax incentives to encourage us to invest. So things like ISAs, even pensions. So the quickest way to get thrown out of a house party is to start talking about pension, because
it's the most fun subject you can have at a house party.
But the thing is, there's new legislation that's come in. It's like auto enrolment, where your employer has to, now by law, has to basically enroll you in a pension, and you get your employer basically tops up what you put in, and also there's government gives you
and that's even if you're in a part-time contract for one.
Exactly. So yes, this is really encouraging people to invest for the long term.
So if you were to give someone a piece of advice and you can only choose one of your 5 in terms of the biggest thing that people should avoid doing, which one would it be?
That's a great question. It's like any guidance, it's very individual to the person. So I would say, well, the 5-step methodology that I go through is each step you have to do it in order. So if you do it out of order, it doesn't necessarily work as good as it could be. But I think for me, it's having enough, like knowing how much is enough, and then basically how much you're going to live on for the rest of life. So a good indicator is 25 times what your earnings is at the moment. So if you have your earnings times that by 25, that's how much assets you need to live on for the rest of your life. And then that's real mindset change, where I was like, well, actually, I just need to get to this amount, and it's once I know that amount, then I can essentially go, right, I can almost, it gives your time back. So time is the most precious asset we have. So if you have enough assets, then you can be, I don't have to work at crazy hours. When I was a trader, you'd work 12-hour days. You're like, why do I do this? If you've got enough assets, and you can do something that's more meaningful with your time. You can work for that charity because you feel like you're doing something with, and it was a mindset change for me.
So we've talked about a mindset change. We've given you the 5 mistakes that people make. But as usual, we're going to end with a chapter from Neil's book. And today he's going to talk to you about why you should have an emergency fund.
So emergency fund, it's like a cash buffer for 3 months of any expenses that you have. So think of it like, I think of it like a fire extinguisher at work. You don't want to use it, but it's there in case for emergency. So if there is a fire, for instance, that it's not going to burn the whole place down. So I think of it like a 3 month of expenses. They're sat in the background that you don't want to touch, unless, say for instance, if you own a house, the boiler breaks down, then you can use it for that. Or if you lose your job unexpectedly, then you can dip into that emergency fund. And it's coming back to the mindset change. So having that as that buffer is a comfort that whatever happens in life, you can lose your job. You can, you can, if anything, you might have to fly across the world to, for a funeral, for anything, any bad stuff can happen. But by having that cash buffer there, it's almost like, it's like a stoic, coming into a kind of stoic philosophy, and it's anything can happen. Like, what's the worst case scenario? And that can happen, but you have essentially like a cash buffer to look after yourself, to essentially, that your financial house doesn't burn down by having to go into your investments or your kind of the assets that you've built up over time.
Exactly, like having that emergency fund, as Neil's already spoken about, could be you've lost your job, could be an unforeseen circumstance in your home, could be a funeral in the family. It's one of those assets, for want of a better word, that you can dip into when you don't know and an unexpected thing has happened. So it's been one of those episodes where we talked about a lot. Hopefully you've got some serious information. Once again, if you do need any more guidance, make sure you follow Neil on social media. You can tweet me or you can @ me as well. And make sure you grab a copy of Neil's book. But we'll see you again for another episode. Thanks for watching.
Thank you.
Money Mindset.
I think that sounds right.